Something is happening in the silver market that no chart, no analyst, and no algorithm was prepared for. A price split so violent, so mathematically impossible, that it threatens the very benchmark the world has trusted for decades. Japan is paying $130 an ounce. COMEX still shows $71, an 80% premium that should not exist in any functioning global market. But it does. And the reason behind it is far more dangerous than anyone realizes, because when two prices exist for the same metal, in the same week, in the same world, only one of them can survive. And the moment they collide, everything changes. And that moment is much closer than anyone thinks. Welcome to Financial Fictions, where numbers don't lie, but systems sometimes do. If you're new here, take a second. Think of it like offering a gentle reminder to someone older than 50 who has seen enough economic storms to know when a warning matters. Click subscribe. Not for me, but for your own protection. And tell me in the comments, where in the world are you watching from today? They watched the number on the screen with a kind of quiet confusion. It said $71. That was the COMEX price. The official benchmark that traders, analysts, and institutions around the world believed represented the value of silver. To most people, it looked normal, stable, predictable. But on the other side of the world in Tokyo, buyers were handing over the equivalent of $130 for the very same ounce of metal. That was not normal. That was not stable. That was not predictable. It was a warning. And in financial history, warnings rarely announce themselves so loudly. He, she, and they, the investors, the factory owners, the businessmen, had seen price differences before. Small ones, 5%, maybe 10% when demand spiked. But they had never seen a gap of 80%. That kind of gap did not happen unless something deep inside the system had cracked. It was the kind of thing that only appeared when the surface price stopped reflecting the real world underneath it. For decades, the COMEX number had acted like a lighthouse. It guided the market. It told miners how to price their production. It told solar companies how to plan their budgets. It told banks how to hedge their positions. But a lighthouse is only useful if it sits on solid ground. And now, for the first time in a generation, people were beginning to realize that the ground beneath COMEX might be shifting. The story began quietly in Japan. The yen had been falling for months. Import costs were rising. Savings accounts were losing real value. Everyday people, especially older savers, started searching for something that did not depend on central banks or government policy. They wanted something real, something physical, something that could not be printed. For decades, they trusted the yen and the system behind it. But trust is fragile. Once it cracks, it rarely returns. So they turned to physical silver. Dealers in Tokyo suddenly found themselves facing lines, long lines of ordinary people, not speculators, not day traders, regular citizens who had lived through years of economic stagnation and currency weakness. They walked into the stores with cash in hand and a simple request: I want real metal. The supply could not keep up. Shelves emptied, bars disappeared, orders doubled, then tripled. And when supply fell behind demand, the price rose. First to $90, then to $100, then to $130. But something strange happened. Even as Tokyo buyers paid $130, the COMEX price stayed near $71. The benchmark did not move, it did not adjust, it did not acknowledge the reality on the ground. A market that was supposed to reflect global sentiment did not reflect any of it. He, she, and they, the careful observers, began to ask the same question. How can one market show $130 while the other insists the value is $71? The only logical answer was unsettling. One of these markets was real, and the other was not. In the real world, an ounce of silver was moving from person to person for $130. People were paying it voluntarily. No one was forcing them. That was the true price of survival. That was the price set by fear, scarcity, and urgency. In the paper world, traders were clicking buttons to buy and sell contracts that settled in cash. They were trading numbers, not metal. The contracts did not need silver to move, only money. The deeper analysts looked, the clearer the picture became. COMEX was showing the price of a promise. Japan was showing the price of the metal itself. The business community watched this divergence with growing concern. Entrepreneurs knew that markets could ignore small signals. But an 80% split? That was not a small signal, it was a fracture. Factories could not rely on the paper price to plan their costs. Exporters could not trust the benchmark to estimate their margins. Even technology firms, who depended on silver for solar panels and electronics, realized their spreadsheets were built on a number that might no longer represent reality. And yet, most institutions continued as if nothing was wrong. They trusted the familiar. They trusted the charts. They trusted the idea that if something unusual happened, the banks would step in to fix it. But the banks were already struggling. Their short positions were bleeding. Their liquidity was thinning. They were not stepping in to fix the gap. They were stepping back. The audience watching this story unfold did not need advanced economics to understand the meaning. When prices split this far, someone was wrong. And in markets, being wrong has consequences. The truth was simple. If people were paying $130 on the street, then $71 in COMEX was not the real price. It was a signal from a system that no longer reflected the world accurately. The only question that mattered now was how long both prices could exist side by side before one collapsed into the other. And the answer, though unspoken, was becoming clearer with every passing day. They looked at the numbers again, not because they expected them to change, but because they needed to understand how such a split could exist in the first place. Prices are not supposed to drift apart like this. Markets are built on the idea that if something is cheaper somewhere and more expensive somewhere else, smart players close the gap. That is the basic rule. That is the foundation of arbitrage. But here, that foundation was failing. And when a foundation fails, the structure above it does not stay standing for long. In a normal world, banks would have stepped in immediately. They would have seen silver selling for $71 on COMEX and $130 in Tokyo. And they would have acted like they always did, quietly, efficiently, profitably. They would buy in one market, sell in the other, and earn a clean and safe return. That process should have erased the spread. But something stopped them. Something in the system that used to connect these two prices was no longer functioning. He, she, and they, the analysts who understood market mechanics, began to explore the missing link. They looked at refinery bottlenecks. They examined transport delays. Silver on COMEX was not the same as silver in the real world. On COMEX, a contract represented a promise, 5,000 ounces that would be delivered someday if both sides agreed, if the conditions were right, and if no settlement rules changed. In Japan, silver was not a promise. It was a bar, it was weight, it was metal in hand. The banks understood this distinction better than anyone. They were the architects of the system. They knew how much metal moved through the pipeline every month. They knew how much could be refined, how much could be transported, and how much could be delivered without breaking the machinery. And right now, that machinery was under pressure. For years, the banks had maintained large, short positions on COMEX. They sold silver they did not have because they believed they could always buy it later. Cheaper, smoother, easier. It was a controlled system, a closed loop. They were the house, and the house always wins. But when the global physical market tightened and demand rose faster than refining capacity, the banks discovered they were stuck between two realities. In the paper world, they were short. In the physical world, they could not source enough metal to stay comfortable. The first signs appeared quietly. Delivery times stretched. Refiners reported delays. Small investors asked for their metal and were told to wait. Nothing dramatic, just small cracks that only the attentive noticed. But when Japan's price hit $130, those cracks widened. Suddenly, the banks' short positions became dangerous, because every dollar silver rose on COMEX meant millions of dollars in losses for them. Losses they had to cover with cash, not later, not eventually. Now, he, she, and they, the observers who studied the commitments of traders' reports, could see this unfolding. They saw the banks reducing their shorts. They saw them stepping back from the usual aggressive suppression tactics. They saw them letting the price rise in slow, controlled steps, not because they wanted higher prices, but because they had no choice. A short position can be manageable when the market is calm. But in a global environment where physical demand is exploding, where Asia is absorbing metal at any price, and where refining bottlenecks slow the movement of bars, that same short position becomes a liability. And so the banks adjusted. They became defensive. Instead of pushing the price down, they tried to control the speed at which it rose. They wanted time. They needed room. They needed to unwind quietly. This was the part most people misunderstood. They looked at the rising price and assumed the banks were losing control. But in reality, the banks were trying to manage the collapse of their own strategy. They were not trying to kill the rally. They were trying to survive it. For the business community, the message was clear. When the institutions that once stabilized a market begin stepping back, the market does not behave as it used to. Prices move differently. Spreads widen. Arbitrage fails. Benchmarks lose meaning. The world was watching an old system weaken. Not suddenly, not dramatically, but slowly, predictably, and visibly. And while many were focused on the headline numbers, the quiet observers understood something more important. A system can stay stable for decades, until the day it cannot. They thought the pressure was coming only from traders and banks, until they looked east. What they discovered there changed the entire meaning of the price split, because the story was no longer about premiums or short positions. It was about something far more structural, a tightening of physical supply so deep that it began reshaping global trade itself. He, she, and they, the researchers following industrial data, noticed a shift that most headlines ignored. Asia, which had always been a massive consumer and refiner of silver, was now quietly pulling more metal inward than it was sending out. Not because of speculation, but because of necessity. The heart of this shift was China. For years, China produced thousands of tons of refined silver annually. Some of it stayed inside the country to feed its massive industries: solar panels, electronics, medical systems, aerospace components. But a portion always flowed outward, balancing global supply. It was the silent stabilizer of the West's dependence on imported metal. But then came a new set of policies framed as licensing and verification procedures. On paper, they looked technical, administrative, routine. But in practice, they created a new reality. Only the largest state-directed refineries could export. Smaller private refiners, the ones who contributed to global supply, found themselves shut out. They now had one customer: China itself. It became clear that China was not trying to manipulate the price. It was protecting its own future. Its solar industry consumed more silver every year. Its electric vehicle sector demanded more conductive materials. Its high-tech factories used silver in ways the West underestimated. And for the first time, China's internal demand exceeded its internal supply. That meant one thing: export flows had to shrink. He, she, and they, the business leaders in Europe and the United States, realized this shift had nothing to do with trading strategies. It was industrial policy, strategic planning, resource nationalism. Silver was no longer just a commodity, it was a strategic input. Without China's exports, the West was left with two main suppliers: Mexico and Peru. But those two nations also faced rising internal demand and rising costs. The flow of metal that once fed Western vaults no longer had the same velocity. Factories in Asia responded first. They began placing larger orders, not because they needed more metal immediately, but because they feared future shortages. This behavior had a name in supply chain theory: just-in-case inventory. It was the opposite of the lean and efficient just-in-time systems the world had relied on. When one company starts hoarding, it looks cautious. When every company hoards, it creates the very shortage everyone feared. This was the shift unfolding in real time. Japanese electronics firms doubled their orders not because they needed twice the metal, but because they could not risk being caught without it. Korean semiconductor plants followed. Chinese solar manufacturers secured long-term contracts at higher prices just to lock in supply. Each of these decisions made sense at the company level. But at the global level, they created an acceleration effect. The available pool of silver shrank faster than anyone expected. Meanwhile, the West continued to rely on financial benchmarks. COMEX still quoted $71. London still issued its daily fix. Western firms still planned budgets using the old numbers. They assumed the market would adapt. They assumed the flow would continue. But he, she, and they, the analysts, knew better. When a major industrial zone refuses to export, the rest of the world enters a permanent deficit. Prices do not rise because of speculation. They rise because of mathematics. Every month, Asia absorbed more physical silver than it released. Every month, global inventories fell a little more. Every month, the gap between physical and paper widened. For business leaders, this was the moment when silver stopped being a background material and became a frontline risk factor. A shortage in the silver did not only mean higher costs, it meant production delays, missed contracts, failed delivery schedules. A company that could not secure silver could not build its product, no matter how much cash it had. That was why the price in Japan reached $130. It was not a panic premium. It was the real price of guaranteed access. The West, which depended on imports, had not yet fully understood this. But Asia had. They were not buying silver because they believed the price would rise. They were buying because they could not afford to run out. And when a region with advanced manufacturing, rising technological capacity, and billions of consumers decides to secure its supply first, everyone else becomes a secondary buyer. This was the new structure of the market, a world where physical silver flowed east, while the West relied on a paper number that no longer had the power to attract real metal. And as the physical river narrowed, the next question became unavoidable. What happens when the West finally tries to buy the metal it thought it always had access to, and discovers the shelves are nearly empty? They turned their attention back to the West, not because the West held the power, but because it held the illusion that COMEX still defined the global price of silver, the illusion that the benchmark still represented real supply, the illusion that paper promises could still command physical metal in a world where Asia was absorbing everything in sight. He, she, and they, the professionals who studied the COMEX reports every week, knew the truth hidden behind the official numbers. COMEX did not store a mountain of silver. It stored two categories, eligible and registered. The eligible pile looked large, but it was misleading. It belonged to private holders who had no obligation to sell. It was metal sitting in a vault because someone paid for storage, not because it was available. The only true supply was the registered category, the bars with warrants, the bars the exchange could actually deliver for contracts. And that pile had shrunk to levels that felt more like a countdown than a reserve. 38 million ounces. 30, 25. Each update was a smaller number. Each number meant fewer days of real supply. He, she, and they, the ones who understood market mechanics, did the math. The world used more than 1 billion ounces of silver a year, 3 million ounces a day. Even a child could follow the logic. A vault with a few weeks of supply cannot anchor a global price. It can only delay a crisis. But COMEX had a mechanism to defend itself, a mechanism older than most traders. It did not need to supply metal if metal ran out. It only needed to supply cash. And cash was the one thing COMEX could always create. That was the safety valve. That was the final shield. If the vaults drained, the exchange would not collapse. It would convert its obligations from metal to money. This was not theory, it was history. Exchanges had done it before. Nickel in 2022, silver in 1980. When too many people asked for delivery, the rules changed, trades were canceled, buying was restricted, cash settlement was enforced. The system survived, but the people expecting physical metal did not get what they came for. He, she, and they, the cautious thinkers, imagined what that moment would look like for silver now. A manufacturer placing an order for bars, only to be handed dollars instead. A fund that wanted physical delivery forced to accept cash at a price far below the real market. A refinery that depended on COMEX inventory suddenly left without supply. The consequences would not be contained to trading desks. They would spill into factories, supply chains, and production lines. A cash settlement might protect the exchange, but it would not protect businesses that needed actual metal to operate. And behind all of this, the physical world continued tightening. Asia's hoarding accelerated. Japanese buyers paid $130, not because they wanted to, but because they had to. Chinese refiners kept their output inside the country. Manufacturers doubled their orders. Miners saw higher prices overseas and redirected shipments east. Every movement drained the West a little more. This was the moment when silver stopped behaving like a commodity and started behaving like a strategic material, one whose availability mattered more than its chart pattern. A material whose control created advantage. A material whose shortage created risk. He, she, and they, the entrepreneurs, the factory owners, the investors, began to understand the deeper message. The price on COMEX was no longer a signal of value. It was a signal of strain, a signal that the market could not reconcile supply and demand, a signal that the benchmark had lost touch with reality. For decades, the financial world assumed that the paper price would always dominate, that metal would always move to wherever the benchmark said it should. But now, for the first time in a generation, the physical market was taking control. The real world price, the Tokyo price, the Shanghai price, the Dubai price was setting the tone. The business community faced a difficult question. What happens when the benchmark collapses upward? Not through a dramatic explosion, but through a slow replacement. One region after another recognizing that COMEX is no longer the center of the market. One contract after another settling in cash instead of metal. One buyer after another choosing to ignore the paper price because it cannot secure supply. In this emerging world, the winners would not be the fastest traders or the most aggressive speculators. The winners would be those who prepared early, who recognized the shift before it became obvious, who understood that physical scarcity, not paper volatility, was the true force shaping the future. He, she, and they were watching the Western vaults drain in real time, and they understood what few were willing to say out loud. When a market built on promises runs out of metal, the price does not simply rise. The price redefines itself, and the world around it must adjust to a new reality.